Welcome to Breaking News to Trading Moves. Imagine watching a high-flying technology stock trade at, 300 times its actual forward revenue. The math screams that it is a bubble, right?
Oh, absolutely. I mean, it is completely detached from reality at that point.
Right. So you initiate a short position, and the very next day, that exact same stock gaps up another 20%.
Ouch. Yeah, that is the reality.
Yeah, you are mathematically correct about the valuation, yet you are financially bleeding. So why does the market brutally punish traders for being mathematically right?
Because, well, math does not buy stocks. People do. And increasingly, algorithmic systems programmed to follow those people, they buy the stocks.
Exactly.
The spreadsheet tells one story, sure, but the sheer velocity of the price action on the screen, that dictates the immediate reality.
Right. So today we are debating the mechanics, the psychology, and the perils of shorting strong, highly valued equities. And the central question is this.
Go for it.
When evaluating a stock that appears vastly overvalued, does that extreme valuation alone provide a valid foundation for a short position, assuming it is managed with strict risk limits? Or does the raw power of market momentum render valuation entirely irrelevant until the trend explicitly breaks?
That is the big question.
Right, so I argue that momentum and narrative completely overpower valuation metrics. Because upside risk is open-ended, valuation is never a timing signal. Traders must wait for actual behavioral changes in the asset, like lower highs or failed breakouts, before initiating a short position.
I come at it from a different way. I argue that extreme valuation is the precise vulnerability that sets up the trade in the first place.
But the timing is impossible there.
Timing is inherently difficult, yes, but combining a valuation-based thesis with strict invalidation levels allows a trader to capture the downside exactly when the stock's narrative inevitably fractures. The extreme price is the opportunity itself, provided you use rigorous mathematical parameters.
I see why you think that, but let me give you a different perspective on how these market mechanics actually operate. Markets do not move simply because a research analyst labels an equity as cheap or expensive.
Sure they do. Eventually.
Eventually, maybe. But they move because of underlying structural forces, institutional positioning, liquidity dynamics, earnings revisions, and perhaps most crucially, narrative momentum.
I hear you. But the cleaner story argument is often just a sophisticated rationalization for ignoring gravity. When an asset trades at those premiums, market participants are building a house of cards.
But the market aggressively pays for that rationalization. Think about it like this. Shorting purely on a rich valuation is like stepping in front of a speeding train simply because the schedule says it should have stopped by now.
Okay, the train analogy is cute, but
Let me finish. The momentum of the narrative dictates reality, not the schedule. We are not just talking about retail enthusiasm here. We are talking about the options market.
right, the gamma squeeze dynamics.
Exactly. Consider a gamma squeeze. Retail and institutional speculators buy massive quantities of out-of-the-money call options on a high-flying stock.
And the market makers who sell those calls are forced to hedge their exposure by buying the underlying shares.
Yes, and as the stock price rises, the delta of those options increases. That forces the market makers to dynamically hedge by buying even more stock. This creates a mechanical, self-feeding loop. It completely divorces the stock price from any traditional valuation metric.
I understand the mechanics of dynamic hedging, but trying to short an overvalued stock without respecting that momentum is like trying to hold a beach ball underwater.
Wait, what? A beach ball?
Yeah, a beach ball. You push it down with your fair value models, but the momentum provides extreme buoyancy. When it slips from your grasp, it snaps back and hits you in the face.
That proves my point. It hits you in the face.
Hold on, let me land the plane here. The air pressure inside that beach ball, the extreme overvaluation, is exactly what makes the eventual pop so violent. Narratives eventually collide with reality.
But when?
Recognizing the severe disconnect between price and reality is the prerequisite for the trade. It is not a distraction. The vulnerability is building with every single uptick.
Yet, identifying that vulnerability does not help you if the market decides to remain irrational for another 18 months.
That is what risk management is for.
But if you step in front of that gamma ramp simply because the valuation is high, you become part of the fuel that drives the stock higher. Predatory algorithms actively hunt for short-side liquidity.
Oh, come on, not every algorithm is out to get the retail short seller.
They look for the exact resistance zones where early short sellers place their stops. The algorithms bid the price up to trigger those stops, forcing the shorts to buy to cover. You are feeding an ecosystem designed to exploit early entries.
You are assuming the trader is using obvious, easily hunted stop-loss placement and poor risk control.
I am assuming the trader is human. Every positive headline forces weak shorts to cover. Every failed breakdown adds fuel to the next move higher. Therefore, a strong trend needs concrete evidence of weakness before it becomes a viable short setup.
I am sorry, but I just do not buy that. Let me tell you why.
Go ahead.
If you wait for all of those elements to align perfectly, the broken support, the fading leadership, the confirmed lower highs, you have often missed the most lucrative portion of the entry.
Wait, so you are advocating for initiating a short while the asset is still actively printing new all-time highs?
I advocate for using a clear mechanical invalidation level. Waiting for an obvious breakdown means you are entering the trade after the most astute market participants have already repositioned.
But the trend is your friend, right?
Sure, until it bends. By the time the trend is definitively broken on a daily chart, the risk-to-reward ratio has completely deteriorated. The price is already adjusted downward to reflect the new reality.
So you step in early.
Exactly. If a trader uses strict quantitative risk control to define exactly where their thesis is wrong, they can proactively probe overvalued setups at logical inflection points. You're testing the trend with defined microscopic risk.
While probing overvalued setups with tight invalidation levels sounds incredibly sophisticated in a textbook, but let us talk about how that actually manifests in the live market.
It manifests as small, controlled losses.
It usually results in death by 1,000 cuts. You probe the resistance, the algorithm spikes the price by 10 cents to trigger your stop, you get stopped out, and then the stock drops.
That is just part of the process.
So you probe the next level, get stopped out again, and the cycle repeats. Math is easy on a spreadsheet, but you are ignoring the execution reality.
It is only 1,000 cuts if you lack discipline and execution edge. The market rewards patience, but it violently punishes stubbornness.
Agreed on the stubbornness part.
Right, so if you define your risk and accept the tiny fractional loss when the invalidation level is breached, you preserve your capital for the moment the catalyst finally arrives. You risk 0.25% of your capital to potentially capture a 30% reversion to the mean.
That brings us directly to the reality of psychological capital. Because mathematically, yes, taking small fractional losses makes sense. Psychologically, it is exhausting.
Cognitive dissonance is part of the job description for any active market participant.
But it is uniquely torturous on the short side. When you buy a stock, the absolute worst-case scenario is that the price goes to zero.
Right, you lose exactly what you invested.
Exactly. You lose what you put in. When you short a stock, the upside risk is theoretically infinite. A bad short trade can move against you aggressively. The emotional pressure builds exponentially with every uptick.
But the risk control mitigates that.
Traders who rely purely on valuation often become righteous. They look at their meticulously crafted discounted cash flow models and they convince themselves the rest of the market is stupid. That ego investment destroys trading accounts faster than almost anything else.
That is a compelling argument, but have you considered that the emotion is managed precisely by relying on the mechanical invalidation level? You are describing a trader who is trading on ego.
Because most are.
I am describing a quantitative trader who uses the extreme valuation merely to identify the target, but uses strict mechanical rules to engage. The psychological toll of being right too early is completely neutralized if you refuse to hold the position once your invalidation level is hit.
I see why you think that, but let me give you a different perspective on how those catalysts actually function in the wild. You suggest stepping aside and waiting to reload.
Yes, safely in cash.
But what happens when the catalyst is ambiguous and creates extreme gap risk? Let us say the company releases an earnings report after the closing bell. They miss on top-line revenue, which confirms your bearish valuation thesis.
Okay.
But the management team spins a narrative on the conference call about artificial intelligence integration, and they raise future guidance. The valuation is still absurd. Your core thesis is entirely intact.
But the stock gaps up anyway.
Exactly. The narrative spins the guidance raise as a massive victory. The stock gaps up 20% at the opening bell the next morning. If you were actively probing that setup, the gap up completely ignores your strict invalidation level.
Gap risk is an inherent structural hazard of the market. It exists on both the long and short side. However, that precise scenario provides crucial empirical data that just costs you a lot of money.
If the stock gaps up 20% on mixed fundamental news, the buyers are clearly not exhausted. Institutional volume-weighted average price algorithms are actively buying the open to participate in that momentum.
Right, so the trend remains dominant.
Therefore, the trader receives immediate, undeniable feedback that the narrative is still overpowering the valuation. You take the loss, which should be mitigated by proper position sizing, and you step away. Exactly. Which proves my central point. The valuation told you absolutely nothing about what the stock was actually going to do. The behavioral reaction to the news dictated the reality.
I come at it from a different way. The valuation told you that when the institutional buyers finally exhaust their capital allocation, the resulting drop will be severe.
But you do not know when that is.
You cannot have a violent price collapse without a severe overvaluation preceding it. The valuation is the stored potential energy in the system. The behavioral change is just the trigger mechanism.
But treating valuation as stored potential energy often creates a false sense of security for the short seller. They look at a high multiple and think, this must come down.
And history shows it usually does.
But the market does not care how uncomfortable a valuation looks to an analyst. A strong stock does not become a good short simply because it feels too high. Let us examine the concept of total addressable market expansion.
Oh, the TAM expansion argument.
Yes. We have seen historical examples over the last decade where a software company trades at 50 times sales and short sellers loudly declare it a historic bubble. But those short sellers were measuring the company against its current market share.
While the buyers were pricing in a global monopoly.
Precisely. The institutional buyers were measuring the company against a total addressable market that was expanding globally. The valuation was not actually extreme if the company successfully executed its 10-year growth plan. They were just pulling 10 years of future cash flows into the present price.
And if they fail to execute that 10-year plan perfectly, if inflation rises and the discount rate applied to those future cash flows drastically increases,
then the price corrects. But until that structural failure is evident in the behavior of the stock, until we see institutional distribution or a clear failure at the 50-day moving average, the safer, more logical move is waiting.
I am sorry, but I just do not buy that waiting for absolute behavioral confirmation is always the optimal path.
Why not? It preserves capital.
Because without a catalyst, an expensive stock can certainly stay expensive indefinitely. But with a known catalyst approaching, say a regulatory decision or a highly anticipated earnings release, the expensive nature of the stock becomes the primary driver of the downside action.
It is only favorable if you can predict how the algorithmic liquidity will react to that catalyst. And as we just discussed with the earnings gap scenario, narratives can instantly spin bad news into a buying frenzy.
Which is why we keep returning to the invalidation level in position sizing. It is the mechanical linchpin of the entire operation.
I am just not convinced by that line of reasoning. Because testing the hypothesis repeatedly in a strong uptrend drains both capital and emotional reserve. Let us examine the specific mechanics of what we call weaker reactions to good news.
Okay, lay it out.
This is a behavioral tell that does not require you to bleed capital early. Imagine a company has beaten earnings estimates for 4 consecutive quarters. Each time, the stock surged 10% on heavy volume.
A classic momentum, darling?
Right. Then, the 5th quarter arrives. They beat estimates again, maybe even by a wider margin. But the stock only rises 1%, or it opens higher and immediately sells off on heavy volume.
That is a classic institutional distribution pattern. The smart money is using the retail liquidity generated by the good news to exit their long positions.
Exactly. The valuation was extreme during all 5 quarters, but it was only in the 5th quarter that the behavior actually changed. The buyers were finally exhausted.
I agree with the pattern recognition there.
If you shorted during the first 4 quarters based purely on valuation, you were destroyed by the gamma squeezes. If you waited for the confirmed behavioral change in the 5th quarter, you had a high probability setup with a clearly defined risk level.
That is a fair point. Though I would frame it differently. Have you considered that waiting for that specific fifth quarter reaction means you are heavily reliant on hindsight?
How is it hindsight? You are watching it happen live.
You are assuming that the behavioral change will be incredibly obvious and clean. Often, a stock will print what looks like a failed breakout, suck in all the momentum-based short sellers who think the trend has broken, and then violently reverse upward the very next week.
A false breakdown?
Yes, the obvious behavioral break is often a liquidity trap.
A false breakdown is certainly a risk, but a false breakdown in a newly fractured trend carries inherently less open-ended risk than stepping directly in front of a parabolic advance that is being fueled by forced algorithmic buying.
True, but survival in those parabolic advances is purely a function of position sizing. The core issue is not shorting extreme valuations inherently. It is the lack of respect for the market's capacity for irrationality.
So we are essentially agreeing that position sizing and absolute risk control are paramount, but we remain fundamentally divided on what dictates the entry.
Exactly.
You argue that the valuation extreme itself justifies the entry, provided the capital exposure is minimal. I argue that entering before the momentum explicitly breaks is a highly dangerous use of capital.
We're dissecting the exact nature of market structure. I view extreme valuation as a tightly coiled spring. You need a mechanism to release the spring, yes, but the kinetic energy is undeniably stored there. Ignoring the immense tension in the spring seems like an incomplete analysis of the opportunity.
And I view extreme valuation simply as a metric that remains entirely subjective until the institutional order flow collectively decides it is no longer subjective. The current price on the screen is the only truth at any given second.
Well, if the current price on the screen is the absolute only truth, then the entire concept of value investing or value-based shorting is entirely void. And we know from decades of market history that while price can diverge wildly from intrinsic value, it eventually violently reconnects.
Eventually. That is perhaps the most dangerous word in the English language for an active trader. In the market, being right eventually is absolutely useless if the trade destroys your account margin first.
Which is precisely why I rely on strict quantitative invalidation. I refuse to let the trade destroy me. If the price moves past my predefined structural level, I am out. I accept the fractional loss. I am not destroyed, I am simply early.
Let us summarize where we stand on this complex dynamic. I maintain that waiting for a behavioral change in the asset, whether that is a weaker reaction to positive news, persistent lower highs, or a confirmed break of support, is the only way to respect the reality of market momentum. Traders must require the market to prove its structural weakness before committing capital.
And my summary is that extreme valuation is the very foundation that creates the asymmetrical opportunity. The vulnerability must exist before the collapse can happen. Strict quantitative invalidation levels are the precise tools that allow a trader to manage the risk and capture that eventual fracture.
It seems we have reached a vital point of convergence, even if our execution tactics remain miles apart. We both structurally agree on the ultimate reality of participating in these extremes. Being right eventually is completely worthless if the trade destroys your capital base first.
We do agree on that. Survival is the primary objective of any market participant. Where we diverge is whether survival requires waiting for the momentum to completely break down, or whether survival is achieved through meticulous risk control applied directly to extreme valuations.
Indeed, it requires an incredibly delicate balance of patience and an ironclad respect for risk. There are certainly more layers to explore regarding how options market makers and dark pool liquidity influence these massive price movements.
Oh, there is always another mechanical layer driving the price action.
Which brings us back to where we started. If logic dictates the spreadsheet, momentum dictates the tape. And trying to predict exactly when that momentum will finally exhaust itself remains one of the most perilous endeavors in trading. The math tells you it must come down. The screen tells you is going up. Which reality do you trust? And more importantly, how much capital are you willing to risk to find out?